Well, do you have any bold predictions for us going forward, or is it just so gray right now that it's hard to make a bold prediction?
Well, I think bold predictions, in line with your earlier question or your comment, the number one structural factor is this wake-up call that investors are having regarding an unsustainable fiscal balance sheet of $36 trillion.
Welcome to Inside the Vault with Bank of Utah, your trusted financial partner. I'm your host, Brandon Hanson, president of the Bank of Utah. Today we have Dr. Lindsey Piegza, one of the leading economists in our country. Let's open the vault to today's episode. So great to see you again, Lindsey. You know, it's been a little bit over 2 years since we first met, and I'm so excited to have you back again. By way of introduction, we have Dr. Lindsey Piegza. She is the chief economist for Stifel Financial. Stifel is a 130-year-old international company that offers a wide array of financial services. Lindsey's a regular guest on CNBC, Bloomberg, CNN, Fox Business, and many other business publications, and we'll post a full bio of Lindsey in the description. So we've got the upcoming Bank of Utah economic event, and you're going to be the feature speaker here in Ogden, Utah.
Yes,
Two,
looking forward to it.
He's so excited, yes. So a couple of years ago, you spoke at the bank's economic event, and at that time, you were calling for rates to be higher for longer, which was very contrary to what everybody else was saying. Everybody was talking about super aggressive rate cuts, and of course, you nailed that prediction. What was it that you were looking at or seeing that influenced your forecast at that time?
Well, first off, good memory from 2 years ago, and thank you again for having me. But I think there was a general lack of appreciation for the stickiness of inflation. And that goes for market participants and Fed officials alike. There was a sense that inflation has subsided, and so it must continue to retreat back to 2%, in part because prior to the pandemic, inflation was always at 2% or below for that matter. So how could this time be different? But this time was very different in the sense that many of the causes of inflation were not so easily adjusted or were not as transitory in nature as expected. And given all the structural shifts that we saw in the labor market, including workers' demand for wages and other compensation, coupled with that unprecedented flood of liquidity into the market, I think it seemed fairly straightforward that inflation would remain stubbornly elevated for a longer period of time, particularly given the committee's hesitancy to raise rates to a sufficiently restrictive level out of fear of inciting negative growth. So maybe a number of overlooked components in the marketplace.
For sure. I remember the CPI inching up, the PCE was going higher, and the Fed was not increasing rates to arrest that increase. Very delayed response, and of course, falls right in line with what you're saying there. So inflation's still not in check, right? We're still in the high twos or maybe threes, depending on what measure of inflation that you look at. What is your forecast regarding inflation? What do you think needs to happen to get that more under control?
Well, inflation certainly is stubbornly sticky at this point, and I don't expect inflation to improve very dramatically in the near term. In fact, we've seen inflation stubbornly sticky with a number of key components and metrics well above the Fed's 2% target. When we look at the supercore CPI or housing components, up over 4%, that's double the Fed's intended 2% target. And with the PPI and the CPI more recently accelerating, meaning gaining momentum over the past couple of years, past couple of months, I think it's reasonable to expect the PCE and the core PCE to trend around 2.5% as we look out to the remaining part of the year. So the Fed still has quite a ways to go, quite a bit of ground to cover before we can talk about reinstating price stability.
What are some of the key indicators or things that you're looking at regarding the national economy? And I mean, it must be pretty challenging to be an economist with all of the flurry of activity in Washington. What are the things that you're looking at as a forecast for this year?
Well, I think when we talk about the broader economy, we're still looking at an economy on very solid footing. Strength in good part, reflecting ongoing resilience on part of the consumer. The consumer, after all, is the backbone of the US economy. So maintaining a good sense of the consumer strength, I think, is really vital to understanding and gauging the underlying momentum of the economy. So that's really what I'm watching as we head further into the new year. And right now, it does appear that there remains a good amount of spending and borrowing power left to continue to carry consumers for some time. And that's even before we introduce the notion of potential fiscal policy measures that may further aid or impact the household balance sheet.
Yeah, that again must be pretty challenging with everything we're seeing out of Washington the last couple of weeks. Immigration policy, funding cuts to various government agencies. It's really difficult to understand maybe how that's going to impact the broader economy, and is probably of quite concern to a lot of our listeners.
Yeah, absolutely. I think when we talk about some of the key priorities of the administration and how they're going to impact the economy, it's a pretty overwhelming topic or overwhelming question. And there's been many proposals introduced on the campaign trail. And we know that campaign trail promises are large, they're light on detail. But that being said, when we parse through some of the rhetoric, I think some of the key priorities for the administration are really going to be tariffs, lower tax rates, more stringent immigration rules, and maybe a more positive focus on domestic energy production. Now, just to kind of give a very basic outline for listeners, as far as the impact, I think in most cases, it's going to depend. It's going to depend on the implementation and the scope of implementation. Tariffs, for example, the big concern here is inflationary implications. Now, I would argue that a one-time price increase, while certainly uncomfortable for consumers that have already been suffering from higher prices for years, lacks the inflationary implications of that perpetual upward momentum in costs. But on the flip side, if this translates into escalating trade disputes, resulting in that tit for tat response, as we saw under President Trump's first term, well, that absolutely does risk sustained price pressures. And under more extreme conditions, I think that could translate into higher inflation by as much as, 3, 4 tenths of a percentage point on an annual basis. Now, on the tax side, I think the same could be said for a significant tax reduction, which on the one hand could lead to a spending binge, a loss of trillions in government revenues and higher prices. But on the other hand, the Trump administration has been clear in that desire to reduce the size of government, reduce waste, inefficiencies. So if they can find enough areas or items to potentially offset or even significantly offset a loss in revenues, we could actually see a pickup in longer run growth in the economy. So I would actually argue that a relatively more fiscally responsible balance sheet could add several tenths of a percentage point to GDP over the coming year or longer. So again, it's very much going to depend on how these policy proposals are implemented, and again, the scope of the policy as well.
Yeah, again, I'm hearing it's got to be very challenging to be an economist right now because of all of the uncertainty and the impact of these changes. And I think what I'm hearing you say that, if there's a one-time tariff and that tariff enables the president to achieve his objectives, that could be a positive thing. But if we get into this tariff war, we're probably potentially looking at more inflation. Well, we've touched a little bit on the labor market. Of course, the first Friday of every month, we get the unemployment report. What are you thinking, or what do you believe you're going to see in regards to the labor market going forward this year?
Well, I think the labor market has remained pretty resilient. Businesses have remained pretty resilient in this difficult environment. That being said, employment has slowed. We've seen the average pace of hiring slow over the past couple of years to a current pace of about 185,000. Now, that's still very positive and still well above the average pace that we've seen in the previous 3 expansionary cycles. So nothing to sneeze at, but we could see a further loss of momentum in top line hiring going forward. Will it be enough to tip the scale for the Fed and present emerging weakness? Probably not for some time. but it's certainly something to keep an eye on, particularly as businesses move away from the traditional input of labor and try to supplement those rising costs with the implementation of technology or AI. So there's a lot of different components in terms of what's driving the labor market. But at this point, I would say businesses are still struggling to find and connect with enough labor to fill the vacancies that are sitting out in the marketplace. We still have nearly 8 million job vacancies. So there's still a sizable gap between labor supply and labor demand.
Yeah, it is. It is interesting for the business owners here in Utah. The unemployment rate is much lower than the national rate, and of course, there's been that imbalance where there's a shortage of workers, which causes price increases and battle for laborers. Maybe some of that evening out could be a benefit for business owners. Do you feel like the unemployment rate is too low in some places, or that's been a positive?
Well, it's interesting because we certainly are seeing some regional differences across labor markets. And I think that the biggest difference is that access to labor, that pool of available resources. When we look at states like California, New York, Illinois, there we're seeing a significant loss of population, a working age population. This is causing a notable brain drain, if you will. And this is complicating the ability for businesses to find and retain workers. While other states like Utah and other states like Texas, Idaho, I would add Nevada, maybe North Dakota to that list as well, we're seeing increases, in some cases, sizable increases in population, which will make it much more favorable for businesses to connect with workers, retain workers, and keep the unemployment rate at those relatively lower levels. And in many cases, we're already seeing businesses relocate in tandem with these changing trends in population. So when we talk about the labor market, we do have to be somewhat careful not to paint with such a broad brush because there are very different labor markets across the US.
Yeah, that makes great sense. I know for our business, it seems like the labor markets has softened a little bit here. It's a little bit easier to find workers and provide those jobs where a year and a half ago it was incredibly difficult. So maybe some balancing there here for us in Utah. Talk to me a little bit about consumer confidence. What's the consumer seeing and feeling at this point? And is any of that driven by feelings about who's in the White House, or what's the data tell us about consumer confidence?
Well, I think consumers are still somewhat optimistic, or at least they were. At the start of the year, we did see consumer confidence somewhat unexpectedly pull back. But even after we account for that weaker read in January, consumers still remain relatively positive, very much in line with the upswings that we've seen in the past couple of years. And I think this increase in confidence, it very much aligns with what we're seeing in terms of consumer activity, that ongoing willingness to spend out in the marketplace. That being said, there are some early signs of caution. And whether that caution is coming from the unknowns of fiscal policy or monetary policy, or it's in a growing level of caution given the financial fragility of many household balance sheets, what we're seeing is that consumers are starting to take at least some steps now to ensure financial viability longer term. And what I mean by that primarily is we're seeing a sizable reduction in credit card usage by the most in over a year. So perhaps consumers still resilient, still optimistic, but we're seeing early signs of maybe a somewhat more cautious trend, both in confidence and spending as we move further into the new year.
Yeah, interesting about the credit card debt. I know some time ago we were seeing a spike in delinquencies, primarily with younger users of credit cards. Has that tapered off? Is that impacting this overall usage of credit card debt?
We are starting to see a pickup in delinquency rates. Yes, it is on the younger users. It's also those with lower credit scores. But when we talk about the uptick that we're seeing, it's still very moderate, nowhere near alarming levels. But again, something to keep in mind, something to keep in a focus on. As we talk about the consumer being the backbone of the economy, if these are early indications of weakness or a slowdown setting in, that's something we need to be very aware of, because that will continue to trickle down into the broader sense of economic potential for the second half of the year.
Let's revisit interest rates. Looking at my screen, the 10-year Treasury is currently 4.44%. We now have a yield curve that is no longer inverted. It was, of course, inverted at a record level of time, and a lot of us were trained that when you have an inverted yield curve, that means a recession is on its way. And I think a couple of years ago, we were talking about hard landing, soft landing. We're sort of maybe in a no landing sort of situation. But what are you seeing for interest rates? And obviously, we think the Fed will probably cut rates at some point to get to some equilibrium, maybe not anytime soon, and depending on, again, how sticky inflation is. But what's your views on the yield curve and maybe kind of long-term where we might see Fed funds and the prime rate end up as an equilibrium?
Well, I think with the changing conditions, with some improvement of inflation, some easing of labor market conditions, does warrant further policy action from the Fed. That being said, I do expect any movement from the Fed going forward to be very tempered, very cautious. The Fed is not in any rush to lower rates. And so when we look at the temperament, when we look at the assessment from the Fed in January, it's very clear that the Fed is not only taking a policy pause, but is increasingly willing to take an extended pause on the sideline, looking at the data, waiting for the data to evolve, and allowing the committee to have a longer period of time to assess the data and the impact of incoming fiscal policy measures. So with that as a background, coupled with the notion that inflation is still stubbornly elevated, notably above 2%, well beyond the timeline that the Fed had previously indicated in terms of reinstating price stability, I think the Fed is on hold for several months. I think we see maybe 2 additional rate cuts this year, but pushed out towards the second half of the year. At the earliest, I would say June and September timeframe, maybe eking out 1 additional rate cut at the start of 26, taking us to potentially a structurally higher terminal rate, or an R star of nearer 375, as opposed to what the Fed is looking for currently around 3.25. So that's likely to result in significantly higher, longer run real rates, a more normal or steeper shaped curve. And again, that higher, longer term neutral level. To quantify that, looking at the 10-year, I think the 10-year stays stubbornly around 460, 465 through the end of the year, maybe pushing higher to 475 as we get into 2026. Amid growing concerns of budget deficits, outstanding debt levels, and again, the realization that inflation is still likely not back to 2%, even after an extended 12-month period looking out to 2026.
Yeah, that's interesting. And the 10-year is very important. A lot of people understand that mortgage rates are priced off of the 10-year Treasury, and so that impacts the cost of housing, which is a particularly difficult issue here in Utah. I think we're the 7th most expensive state now for housing, and so that impacts us. It was interesting. I heard today the new Treasury Secretary talking about Trump being more focused on the 10-year. Of course, kind of coming in, campaigning, back to your point about campaign promises, it was all about we're going to cut rates, we're going to make the environment more business friendly. Sounds like he's pivoted a little bit and is suggesting that, if we can get the 10-year Treasury to be lower, that's more helpful for the economy.
Well, I think anytime you reduce borrowing costs, or reduce the barrier to additional access to capital and liquidity, that can certainly fuel consumption and investment booms. But that being said, the White House, of course, does not have direct control over the Treasury market or longer term yields. Now, they can have de facto influence over short term rates, by maybe pressuring the Fed. And that's nothing new. I'm not picking on the Trump administration. Every administration in history has wanted low rates from the Fed in order to goose the economy under their reign. So that's one way they can have an influence. The second is by influencing the factors that are potentially providing a floor to longer term rates. And I think the number one structural factor is this wake up call that investors are having regarding an unsustainable fiscal balance sheet of $36 trillion. So again, this goes back to one of the Trump administration's key agenda items, weaning out waste and inefficiencies and reducing the size of government. If they're able to do that, if the administration is able to do that, that could severely lessen the market's concern about inflationary implications as a result of massive government spending. And that could put a cap on longer term rates or even translate into downward pressure on longer run rates.
Yeah, that's a really interesting point. I know Treasury Secretary Bessent has been critical of the past administration, putting a lot of focus on the new debt, the new Treasury issuances being at the shorter end of the curve, and that needs to be staggered further out. We've got $36 trillion of federal debt, and I think about a third of it reprices this year in 2025. It'll be interesting to see if, when they issue new debt, if it's going to be at the longer end of the curve, the 5, 7, 10 year, or if we're going to continue with the short-term borrowing and that structure and that impact on the economy.
Absolutely. And that's a little bit of the shell game, where exactly the debt's going to be issued. I think if the Trump administration really wants to have an honest impact and lasting impact on longer run rates, it's about decreasing the overall amount of debt or the need for new issuance up and down, excuse me, up and down the curve.
Again, I think it's also important to point out that, again, the president doesn't influence long-term rates and maybe some influence de facto with short-term rates. It's the Federal Reserve. And of course, they have a dual mandate to keep inflation low and to maximize a strong employment market. And so that's where the influence is. And it'll be interesting to see if there's a break in the labor market. That maybe would cause them to decrease rates faster than what we're talking about. But short of that, if the labor market stays strong, yeah, I could see things kind of trending like they are now.
Yeah, absolutely. And remember that the president did make a comment early on about wanting more direct control over monetary policy in terms of proposing or implementing monetary policy. But those comments have really been rolled back. That being said, to your point, the administration does still have a direct role in altering the composition of the Federal Reserve Board. Now, publicly, they said they will not seek a replacement for Powell prematurely. But remember, Powell's term naturally expires in May of 26, along with three other appointments to the board over the next 4 years. So there's going to be a very interesting opportunity for the Trump administration to potentially stack that proverbial Fed deck with more dovish-leaning members who may then be more inclined to support the notion of less restrictive policy or lower interest rate policy going forward.
Yeah, interesting. Of course, we had the vice chair of the Federal Reserve, Michael Barr. He stepped down.
Of course, yeah.
I don't believe they've elected anyone. I think the talk has been that Mickey Bowman may take that spot. And of course, the vice chair is over supervision of the banking system. And she seems to be quite friendly with the banking organizations. So will be interesting to see that. But I was not aware of the other positions that the White House may have some influence over appointing in the future. Well, do you have any bold predictions for us going forward, or is it just so gray right now that it's hard to make a bold prediction?
Well, I think bold predictions, in line with your earlier question or your comment about our long-standing forecast pushing against consensus in terms of calling for higher rates for longer, I think, again, I would err on the side of maybe pushing back against consensus in terms of policy and performance expectations. Meaning, is it more likely for the Fed to cut rates more or less? I would say less. Is it more likely that yields move higher or lower at this point? I think the risk is still to the upside. And from here, on an inflation standpoint, is it more likely that inflation cooperates and returns to 2%? Or remains stubbornly elevated or even pushes higher still? I think with the levels of inflation that we're seeing in some of these components, particularly housing, I would argue the risk is not just elevated price pressures, but prolonged elevated price pressures. So, in terms of bold predictions, I really see the risk to being to the upside in terms of rates and inflation for quite some time.
Well, thank you. Well, hey, maybe a couple of fun questions as we're wrapping up.
Yeah.
If you could have lunch with any economist or financial figure in history, like who would you want to have lunch with?
Goodness. Well, we could look throughout history for fascinating people, and I'm sure we could find a laundry list, but I'm not convinced that I need to look too far into the past. We've had plenty of interesting and unprecedented market events in recent times. So it may be as simple as sitting down with Ben Bernanke or Hank Paulson. I would love to ask either of them, where did you get it wrong? And if you could go back, what would you do differently? What's your largest regret of handling the financial crisis?
Yeah, yeah, that was an interesting time for sure. A lot of lessons learned.
Yes, absolutely.
Economic buzzwords. What gets overused? What do you get tired of hearing about?
Well, I think it's kind of come out of favor now, but I would say that transitory was
Oh
well,
yeah,
that was well overused. Yes.
I love it. Well, thanks for your time. I appreciate you being with us. Very much looking forward to next week seeing you in person in Ogden, Utah at the Bank of Utah Economic event. So thank you so much for your time.
Thank you for having me. I look forward to seeing you as well.
Okay, we're set. We'll see you next week, Lindsay. Thank you.
Great. Looking forward to it.
Okay,
Have a
see
good
ya.
weekend.
You too. See ya.
Bye.
From all of us here at Bank of Utah, thank you for listening to Inside the Vault. We'll see you next time.